Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, Goldman Sachs just exited its entire XRP ETF position. 154 million gone, and within hours, panic exploded across crypto. Headlines screamed, social media melted down, retail investors assumed the worst. But what if the market completely misunderstood what actually happened? Because beneath the fear, beneath the volatility, something far bigger may have just been revealed. Institutional buyers didn't just absorb Goldman's entire sell-off. They bought even more. And at the same time, governments, regulators, banks, and financial infrastructure giants are quietly building the foundation for a tokenized financial system that XRP may already be positioned inside of. This isn't just about price anymore. Let that sink in and write that down. This is about infrastructure and the difference between short-term panic and long-term structural change. The crypto market has always had one major weakness. It reacts emotionally to headlines, one large sell order, one regulatory rumor, one institutional exit, and suddenly the entire narrative flips from optimism, catastrophe. Always. It's crazy. That's exactly what happened. When reports surfaced that Goldman Sachs had sold its entire XRP ETF position, worth approximately $154 million, immediately the market interpreted this move as a warning sign. People assumed Goldman knew something, that smart money was exiting, that institutional confidence in XRP was collapsing. But here where it gets interesting. When you actually examine the data behind the move, the story changes completely. Because the same week Goldman exited, XRP ETFs still recorded net inflows of roughly $60.5 million. Think about what that means for a second. If Goldman Sachs sold $154 million worth of exposure and ETFs still ended the week positive, then institutional buyers absorbed the entire liquidation and added another $60 million on top of that. Let that sink in. That's huge. That represents more than $214 million in total buying pressure. That's not weakness, demand. That is the distinction that matters enormously. Because in modern financial markets, understanding who is buying, why they are buying, and what role institutions actually play is far more important than reacting to headlines. That's why I always say, ladies and gentlemen, we're the remora swimming underneath the apex predator, and we will not get cut up like sushi, ladies and gentlemen. That is why I harp on this. Now, this is what most people miss. Investment banks like Goldman Sachs often hold ETF inventory for operational purposes, not ideological conviction, not long-term belief, not XRP to the moon, baby. Their role frequently involves market-making activities, providing liquidity, facilitating client flows, managing temporary inventory. So in other words, a bank holding ETF shares does not automatically mean that bank itself is making a directional bet on XRP. Sometimes it simply means clients are buying and selling exposure through them. And this becomes even more important when you realize XRP wasn't the only asset being reduced. Reports also showed exposure reductions across other crypto-related products tied to Ethereum, Solana, and Bitcoin. That changes the context entirely, because instead of looking like a target attack on XRP, it begins to resemble broader portfolio rebalancing, operational adjustments, risk management, balance sheet optimization, the kind of routine institutional behavior that retail investors often mistake for hidden insider doom. Short-term noise, long-term structure. I always say this, pay attention to what's quiet. That phrase may become one of the most important ideas investors understand over the next decade, because price is reacting while the system itself is evolving underneath. And historically, that's exactly how major financial transitions have always looked in the beginning. In the mid-19th centuries, railroad companies transformed the American economy. At first, investors viewed railroads as speculative chaos. Stocks crashed violently. Companies failed constantly. Panic spread repeatedly throughout markets. But underneath the volatility, the infrastructure itself kept expanding. Tracks kept being laid. Commerce accelerated. Settlement times shrank. Entire industries reorganized around the new transportation system. And eventually, railroads became the backbone of industrial economic growth. The investors who focused only on short-term crashes often missed the structural transformation happening underneath the panic. That historical pattern appears again and again throughout financial history. And today, many analysts believe blockchain infrastructure may be entering a similar phase. Messy, volatile, speculative, but so structurally important because while traders focus on ETF flows and price candles, institutions appear increasingly focused on something much larger, tokenization. Tokenization may become one of the biggest financial shifts of the next generation. And this is where XRP enters a much bigger conversation than most people realize. One of the most overlooked developments recently came out of Dubai. The Dubai Land Development launched a government-backed initiative involving the tokenization of real estate title deeds using the XRP ledger. That is an extraordinary development. Not a meme coin partnership, not marketing hype, not a speculative announcement, actual government-linked infrastructure, official property records on a public blockchain framework. And the implications are enormous because real estate title systems are among the most legally sensitive databases in existence. Governments do not experiment lightly with property ownership records, which means this move suggests growing institutional trust in blockchain-based infrastructure capable of supporting regulated asset systems. But the real shift came when tokenization stopped being theoretical and started becoming operational. For years, blockchain discussions existed mostly in white papers, conferences, and pilot programs. Now we're beginning to see governments, financial institutions, regulators, and settlement networks preparing actual deployment frameworks. That transition changes everything, because once infrastructure moves from experimental to integrated, capital flows, and XRP's positioning inside that conversation may explain why institutional interest continues despite volatility. Another major development that resurfaced recently involving Ripple and the DTCC, the Depository Trust and Clearing Corporation. For anyone unfamiliar, the DTCC is one of the most important pieces of financial infrastructure in the United States. It processes and settles enormous volumes of securities transactions globally. Especially, it helps the modern financial system function behind the scenes. Years ago, Ripple and the DTCC reportedly participated in discussions surrounding interoperability between blockchains and tokenized asset systems. At first, they may sound technically and boring, but in reality, it addresses one of the largest future problems in digital finance: liquidity fragmentation. Imagine a future where stocks, bonds, real estates, commodities, and financial assets exist across dozens of separate blockchains. Those systems cannot communicate efficiently. Liquidity becomes trapped. Settlement slows. Cost rises. Institutions avoid adoption. Interoperability becomes critical. And Ripple's early positioning around cross-network functionality suddenly looks extremely strategic in hindsight. Write that down. Now, this is what most people miss. Large institutions rarely move quickly. They move slowly, deliberately, and years before the public notices the implications. The groundwork for major financial transformations is usually built quietly. That's why I always say pay attention to what's quiet, long before headlines ever catch up. So, in the early days of the internet, most people focused on websites, the visible layer, the flashy consumer products. But the real winners often became the infrastructure, companies behind routing systems, fiber networks, and back-end protocols. The invisible plumbing. Some analysts believe blockchain markets may evolve similarly. Speculative tokens may come and go, but infrastructure enabling settlement, interoperability, compliance, and tokenized asset movement could become the foundational layer of the next financial era. And that's precisely the category XRP supporters believe Ripple is targeting, not merely retail speculation, but institutional rails. Whether that thesis fully materializes remain uncertain, but the direction of regulatory development suggests the broader tokenization movement is accelerating rapidly. One of the biggest catalysts potentially approaching comes from the U.S. Securities and Exchange Commission. Reports indicate the SEC is preparing frameworks or innovation exemptions, specifically addressing tokenized securities trading, and this is critical because for years, digital asset markets have existed inside regulatory ambiguity, especially regarding securities law. Institutions hate uncertainty. Pension funds, banks, asset managers, settlement firms. They generally avoid deploying massive capital into legal, undefined systems. But if regulators begin establishing explicit frameworks for tokenized securities, that changes the environment dramatically, ladies and gentlemen, because suddenly tokenized assets move from gray zone experimentation into regulated infrastructure, baby. And once regulation becomes clearer, institutional participation often expands, not because institutions suddenly believe in crypto, but because they can finally operate within compliant frameworks. That distinction matters enormously. The future of blockchain adoption may not depend on ideology. It may depend on legal clarity, operational efficiency, and infrastructure capability with existing financial systems. This is where XRP supporters frequently point toward one specific advantage of the XRP ledger: compliance functionality. Features like KYC integrations, AML compatibility, issuer control, and clawback mechanisms may sound controversial to crypto purists, but for institutions, those capabilities matter because banks and governments cannot simply operate inside anonymous systems lacking compliance safeguards. Regulated finance requires identity frameworks, auditability, transaction controls, legal reversible mechanism in some contexts. You got to have these mechanisms. Whether people philosophically agree with that model or not, that is how institutional finance operates. And as tokenization expands, blockchains capable of supporting compliance-heavy environments may gain advantage in regulated sectors. Prices reacting, systems evolving. That may be the central story unfolding right now. But ladies and gentlemen, back in the 1970s, institutional banking faced a massive communication problem. Banks around the world relied on a fragmented messaging system, manual confirmation, slow settlement coordination. Cross-border finance was inefficient and error-prone. Then came SWIFT, the Society for Worldwide Interbank Financial Telecommunication. At first, few people understood its significance. It wasn't flashy, it wasn't consumer-facing, but over time, SWIFT became foundational infrastructure for global banking communication, not because average citizens loved it, but because institutions adopted standardized systems that improved efficiency and interoperability. Some analysts suggest blockchain infrastructure could undergo a comparable evolution, where the true value emerges, not from speculation alone, but from becoming embedded inside the architecture of global finance. And this may explain why so many large institutions continue exploring blockchain integration, despite market volatility, because they are not merely chasing token prices. They are studying infrastructure transformation. Now let's zoom out even further. Ripple's ecosystem discussions have at various times involved major names connected to global finance. JP Morgan, MasterCard, NASDAQ, central bank initiatives, cross-border payment discussions. Some partnerships evolve, some remain exploratory, some never fully materialize. But collectively, they reveal something important. Large financial institutions are no longer ignoring blockchain technology. That phase is over. The conversation has shifted from will blockchain matter to how do we integrate it safely into existing financial systems. That is an entirely different stage of adoption, and timelines appear to be compressing rapidly. 5 years ago, tokenized finance sounded futuristic. Today, regulators are discussing operational frameworks. Governments are launching pilots. Asset managers are issuing tokenized products. Settlement systems are exploring blockchain interoperability. The shift is no longer theoretical. It is increasingly infrastructural. But here's where it gets really interesting. The market still often prices these developments emotionally rather than structurally. One bearish headline can erase billions in market capitalization overnight, even while institutional infrastructure quietly continues developing underneath. The disconnect creates enormous confusion for investors, especially retail participants trying to separate noise from signals. Ladies and gentlemen, when electricity first emerged commercially, markets experienced waves of hype, speculation, and collapse. Many early electric companies failed. Investors lost fortunes. Public confidence fluctuated constantly. But despite the chaos, electrification itself kept spreading. Factories adopted it. Cities integrated it. Infrastructure expanded relentlessly. The technology outlived the volatility. Some observers believe blockchain infrastructure may follow a similar path. Not every project survives, not every token survives or succeeds, but the broader transition towards digital integrated financial systems could continue regardless of short-term market fear, and that distinction may be critical and crucial for long-term investors. Let's go back to Goldman Sachs for a second, because the emotional reaction to their XRP ETF exit reveals something deeper about modern markets. Many investors still interpret institutional activity through simplistic narratives. If a bank buys, bullish. If a bank sells, bearish. But reality is far more complex. Institutions rebalance constantly. Market makers rotate inventory. Risk desks hedge exposure. Client flows shift allocations. Liquidity providers optimize balance sheets. A sell order alone does not explain intent. Content matters, and the context surrounding Goldman Sachs' exit appears far less dramatic than social media initially portrayed, especially considering the broader institutional demand that absorbed the entire position almost immediately. That absorption matters tremendously because markets reveal strength, not merely through price appreciation, but through liquidity depth. When massive positions can be absorbed without systematic collapse, it signals mature demand characteristics. And that may be one of the most underappreciated details in this entire story. There's another layer here too. Institutional investors increasingly operate on multi-year infrastructure timelines. Retail market often operates on hourly emotional cycles. Those perspectives frequently collide. One side watches candles, the other side studies settlement architecture. One reacts to headlines, the other evaluates regulatory trajectories. And over time, structural adoption tends to matter more than temporary fear cycles. That does not mean XRP is guaranteed success. Far from it. Risks remain substantial. Regulation could evolve unpredictability, and competition among blockchains remains intense and fierce. Institutional adoption may progress slower than expected. There are no guarantees in financial markets, but the broader direction of travel appears increasingly clear. Traditional finance is moving toward tokenization, and the institution building infrastructure for the future may become critically important. And one of the strongest signals supporting that thesis is the changing behavior of regulators themselves. For years, crypto regulation focused largely on enforcement, warnings, lawsuits, restrictions, lions and tigers and bears, oh my. Now, conversations increasingly include frameworks, exceptions, compliance standards, operational pathways. That shift is subtle, but enormously significant, because mature industries eventually move from prohibition debates to integration frameworks. And tokenized securities receive formal legal treatment, entire new markets could emerge around compliant digital asset infrastructure. That's why many analysts are closely watching developments involving public blockchain capability with regulated finance. And XRP frequently appears inside those discussions because of its longstanding institutional positioning narrative. And again, whether XRP ultimately dominates that space remains uncertain, but its continued presence inside institutional and regulatory conversations is difficult to ignore. Meanwhile, retail panic cycles continue repeatedly. A large sale happens. Fear spreads instantly. People assume a collapse is imminent. Yet underneath the volatility, governments continue experimenting with blockchain settlement. Banks continue exploring tokenized assets. Regulators continue drafting frameworks. Infrastructure continues evolving. Short-term noise, long-term structure. That phrase may summarize this entire moment in crypto history, because what we are witnessing may simply not be another speculative cycle. It may be the gradual construction of a new financial architecture layer. And infrastructure transitions often look chaotic while they're unfolding. Most people only recognize structural evolutions clearly in hindsight. They're also an important psychological dimension. Investors should consider human beings are naturally drawn towards dramatic headlines. Fear spreads faster than nuance. Headlines saying Goldman Sachs dumps XRP travels faster than institutional inflows exceeded liquidation volume by 60 million. But the second headline may actually matter more, because markets ultimately care about demand. And the data suggests institutional appetite for XRP exposure remains very much alive, especially as broader tokenization narratives accelerate globally. That doesn't guarantee immediate price appreciation. Markets can remain irrational longer than many expect. Volatility can remain severe, but long-term adoption trends often unfold independently from short-term emotional reactions. And historically, the biggest financial opportunities sometimes emerge precisely when markets misunderstand structural change in real time. The coming years could become extremely important for blockchain infrastructure, not merely for trading, but for settlement, tokenization, asset mobility, cross-border interoperability, compliance integration. That is the battlefield institutions increasingly appear focused on. And XRP supporters argue that the project has spent years positioning itself for exactly that environment. While the history ultimately validates that thesis remains to be seen, but the pace of institutional development surrounding tokenized finance is undeniably accelerating. Dubai, the SEC, DTCC conversations, government initiatives, institutional pilots. These are not isolated headlines anymore. They are pieces of a larger structural pattern. And when viewed together, they paint a far more complex picture than a single ETF, liquidation headline. So what should investors take away from all this? First, separate operational institutional behavior from conviction narratives. A market maker inventory adjustment is not automatically a bearish thesis. Second, watch infrastructure more closely than emotion, because price can fluctuate wildly while adoption quietly advances underneath. Third, understand the difference between speculation and structural integration. Speculation drives short-term volatility. Infrastructure drives long-term relevance. And finally, recognize that financial transformations rarely happen all at once. They unfold gradually, then suddenly. For years, blockchain integration looked theoretical. Now governments, regulators, and financial institutions are increasingly building operational frameworks in real time. That transition may prove far more important than any single weekly price movement. Ladies and gentlemen, Goldman Sachs selling its XRP ETF exposure created fear, but the deeper data may tell a very different story. Institutional buyers absorbed the entire position, and still many pushed inflows. Institutional buyers absorbed the entire position and still pushed inflows positive. Meanwhile, the broader environment surrounding tokenized finance continues evolving rapidly. Governments are experimenting. Regulators are drafting frameworks. Financial infrastructure giants are preparing for interoperability. Compliance-ready blockchain systems are gaining attention. Prices are reacting, but the system is evolving. And that distinction may define the next era of digital finance. The real question investors must ask is not simply, what did Goldman Sachs sell, but rather, what kind of financial system is being built underneath the headlines? Because the answer to that question could matter far more over the next decade than a single institutional rebalance ever will. Ladies and gentlemen, the larger financial system may already be slowly repositioning underneath them. Short-term noise, long-term structure. Pay attention to what's quiet. Prices reacting, systems evolving. If you've enjoyed this breakdown, make sure you hit subscribe, hit the like button, and join the wolf pack, because we're tracking the macro shifts, the institutional signals, and the structural changes most people overlook. Always do your own research. Never invest based solely on a YouTube video. And remember, short-term noise, long-term structure. Pay attention to what's quiet. I'll see you in the next one. Hope everyone's enjoying their weekends, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Test Monthly, all the new members of the membership channel. Ladies and gentlemen, when I say that we're the remora underneath the apex predators, we're following what the major players are doing, shifting their money. That was drilled into my head before the New York Mercantile Exchange, except we were looking at the COT pages. We were looking at data. We were following things. I'm working this weekend. The airspace over Iran was closed. Looks like kinetic energy and kinetic actions may be coming. Who knows? But like I said, I'm married to this game. So if you're here watching this video, thank you for sharing some time of your holiday weekend with us. Patience is the most important thing right now. What most people on the street are doing, they're taking advantage, trading 5 to 7 different financial assets, playing the ranges, taking part of the alpha made from playing the ranges directionally, not going against it directionally. And then they are hoarding crypto, oil, energy stocks, and a lot of regional plays in certain areas. I've been doing this for so long. This, to me, is what my entire career was based upon, besides our refineries in Indonesia and Southeast Asia and Central Africa. I look at this and I say to myself, and everyone that retains any capacity, because I always want to know about this, this is the greatest resource grab of our lifetime. This is the going from the old regime to the new regime. This is more valuable than running after certain commodities. Again, we get phone calls every day, people looking to source metals in the ground, and we have long offtake agreements that we've signed with massive people who've been buying for us for the last 20 years. I want you to enjoy your holiday and think about why you're in crypto. I don't work for retail people, so it's hard to discuss these things because we're looking from a different perspective. The biggest thing I can tell the retail people is this. Look, you'll know if you have too much into something, if every day the candle's going one way or another, crushes your mind. If you can't sleep, you know you have too much in it. Where you'll know you don't have enough of it is if using certain metrics and price points in the other videos we went over about dominance, market caps, price, at some point, those will divorce from reality and move into a new financial reality. When that happens, ladies and gentlemen, the price is going to have a rip your face off rally. I've watched the prices of commodities my entire life, from the time when the Floyd traded Lucky. And if you're watching this, Lucky, I'm happy that day you you told me to stop reading Dungeons and Dragons and watching the boards. The prices of these assets won't remain the way they are. We will be depressed for a little while longer. If action begins, the markets will crash. Then they will go higher. This is the law of the market, ladies and gentlemen. If you want to learn how to take advantage of the volatility in 5 to 6 to 7 financial assets that the whole street is trading right now, so that you can use part of that alpha to build larger holdings of certain cryptocurrencies and certain oil and gas stocks. Do come and join us in the Crypto Republic Desk monthly. Join over 560 active traders and investors who are learning how to take their own financial destiny in their hand and want to know what floor traders were taught on the floor of the Mercantile Exchange when the floor still existed. One good tip from the pits can pay for your entire year subscription. I love hearing the comments where people think they actually joined a real group. Those are my favorite comments. And we have traders and investors from around the world: Australia, Canada, Germany, the Netherlands, the United Kingdom, America, Singapore, everywhere, Korea. It's amazing, the group of people there, the men and women that have taken their hands on destiny. But why we're the financial mercenaries is we take what we need from the battlefield of finance every day and we build our own nest egg. Floor traders and locals are a special breed. I don't like banks, ladies and gentlemen. I don't trust politicians. To me, police and thieves are natural brethren. I don't trust politicians. Look what's happening in today's world. Food's going to be expensive. If you've been following us here, you've been following nickel, copper, silver, gold, tungsten, and certain LNG plays and oil, and understand that we love XRP, the anointed one, ICP, and HBAR. This is the biggest grab of commodities we will ever see in our lifetime. I have waited my entire financial career for a moment like this. I almost understand what General Patton must have felt like when he said certain things, that he finally had certain things at a certain place, certain time in his lifetime. I've been developing concessions for the last 20 years in some of the most remote, austere regions on the planet. This time in history is the greatest resource grab because we're going to go from physical commodities into the blockchain world. It's going to detach. You know, I love the fact that people are getting involved in this because, again, most assets people are priced out of. If you have too much of something, you won't be able to sleep at night. If you have too little, maybe you could see what makes sense for your own situation. I didn't want to be a financial mercenary. I was forced into it. And I'm happy that my father forced me to get onto the train and the subway and start working at 15 years old on the floor of the Mercantile Exchange. I'm happy my uncle and everyone was that hard on me to learn this. And I have created this republic with the other senior partners in our organization so we can help people get to where they want to go to give back. To give back. You make a living by what you make, by life, what you get to other people. If you want to get to where you want to go and understand this, and you're listening to this, come and join us. Get off the sidelines. This opportunity is going to come and go like that. I look at banks and I traded alongside them on the floor of the New York Mercantile Exchange. I clerked for some of the biggest names at these banks. They don't care about us. They never will. To me, I look at financial banks as a sports team. I know what plays they play and why, when they do this and when they don't. I love you all, ladies and gentlemen. I want you to have a great weekend. I'm going to be here working. We're going to have another video tonight at 7, another video tomorrow, another video at 7, because we believe things are going to happen. When people ask what it's like to be a financial mercenary, I'm here in the office working while everyone else is with their families. That's why if you're looking to get ahead and you want to understand how to take advantage of the swings in the dominant commodities and put that to work with your family and actually learn how to do all this so that you can do it on your own, come and join the Crypto Public Desk monthly. Join over 560 traders worldwide. Ladies and gentlemen, this time period will pass. The only thing that's going to matter is did you take advantage of it? That's it. I love you all. I'll see you on the front lines. This content is for informational and entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You've got two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never happen again, or you can be like the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. I'll see you at 7 tonight.